Fed Chair Jay Powell set to testify on the Hill this week, and investors will get the all-important jobs report on Friday, events that could affect the direction of the markets, all of them. For more on that, let's bring in Dana Peterson, chief economist at the Conference Board, and covering the equity angle, Nate Thooft, chief investment officer and senior portfolio manager of the multi-asset solutions team at Manulife Investment Management. I worked hard on your name, Nate, and we were just talking. Your entire life, have you ever not had to explain it to someone? Has anyone ever gotten it right first try?
Never gotten it right the first try, but good job today.
Yeah, I did a darn good job. It's Thooft, but I just can't imagine every time someone's been growing up and everything else. God bless you. Let me start with you. Let me start with you, Dana. Is it possible that some of the recent conjecture from, I guess, some hawkish economists, no cuts this year, is that possible?
Anything's possible, but it's certainly not our base case. We do believe that inflation will continue to slow. Indeed, when we look at the year-on-year inflation rates for both the CPI and the PCE deflator, which is what the Fed benchmarks its policy against, they're both slowing on a year-on-year basis. So you can't just look at the month-on-month readings. And the Fed needs to feel comfortable that these inflation gauges will descend upon 2% and remain there sustainably. And once they feel comfortable about that, they'll begin to cut interest rates. And we think they'll probably start doing that around the middle of this year.
Dana, if suddenly we thought that you could have good growth in the economy and it's not necessarily inflationary, why wouldn't you? Why wouldn't you get as much output as you possibly could? Plus, never hurts during an election year to have the wind at your back and if you want to get reappointed and everything else. So I can see what you're saying, but if inflation doesn't come down, I can't imagine that they would cut.
Well, first of all, the Fed is not really concerned about elections. They're focused on monetary policy. They are independent. So whatever they need to do for the economy, they're going to do it regardless of the election. But the thing is that inflation is slowing. And so that's something that the Fed needs to continue to see. Now, when we look at the economy, the data have been mixed to start the year. Certainly consumer spending was pretty weak, and also incomes and after-tax incomes in real terms are slower. So the thing is that we may continue to see this weakness. We think that the U.S. economy is probably going to slow, probably to a growth rate between 0 and 1% over the course of the second and third quarters. And that will also give the Fed impetus to start cutting interest rates.
Nate, I think you believe that the path of least resistance is a continuing upward move in equities?
We do. We do think that there's a potential for broadening of breadth. We've already started to see it this year. If you look at things like small caps, parts of the EM world, some sectors that didn't do well last year, like healthcare, we're already seeing a broadening of participation in the market. Now, a lot of that is driven, in our view, that we're seeing a broadening in the earnings profiles as well. Last year, we had pretty narrow markets driven by, as we all know, AI and tech driven. But this year, we're starting to see earnings growth coming from other areas and broader participation. And we think that will continue throughout the course of 2024.
That would certainly help in terms of broadening out. Is that dependent on the economy staying strong, would you say, Nate? And is there anything that you see at this point that shows that there's some cracks in that narrative that the economy is going to stay strong? Because now we're not expecting a recession. That's when you usually get one.
Man, I think there's definitely areas that we see a bit of concern, particularly around the potential for job weakness. Right now, job data is really, really strong, but there's some underlying things such as intentions to fire versus intention to hire that are starting to go in the direction of getting a little bit of worse. But generally speaking, our base case is that the economy will hold up pretty well, and you have an environment that is pretty good for equities. Now, that is predicated on the fact that we too believe inflation is coming down over time. Yeah, we have a little bit of an air pocket here in the next couple of months, perhaps. But if that happens, the Fed is very likely to cut, let's say, 3/4 points for an entire 1% during the course of this year, which will help keep that narrative alive around the broadening of participation in the broader equity markets.
Well, speaking of participation, Dana, back to your purview, what will allow inflation to come down, given that the job market is still seems to be so tight? I mean, unemployment is so low. Could you see participation rate? Could the participation rate start going up? Is it still too low? How does people going back to the office and the whole idea of 4-day work weeks, it doesn't seem like we're back to maximum, not maximum employment, but there are still arguments. Well, I want to stay home and I want to work 3 days a week. So it seems like there's still some slack left in labor.
Well, when we think about the participation rate, it's still well below the 2019 level. And so when you break it up into two pieces, so you have the people who are 15 to 64, their labor force participation has actually recovered and it's above the 2019 level. It's people over 65. Those folks dropped out of the labor force during the pandemic and they have not returned. And many of those people are baby boomers and they're going to be retiring. And so I don't really see much slack in the labor market. It's still a very tight labor market because of these labor shortages. And when we think about what's driving inflation, housing prices and indeed rents are slowing, and that's showing up in the inflation gauges. So that's a downward pressure. But an upward pressure are wages, certainly because we have these persistent labor shortages in certain sectors of the economy.